Hello, this is Edward Lambert from the Effective Demand Research, continuing the exploration into the Cobra equation. And this is a picture of the Cobra equation as a curve in 3 dimensions. And just a brief summary of what this is that the x-axis here is your increasing utilization of capital. Y-axis, your increasing utilization of labor. And the graph here shows increasing profitability. So as you increase utilization of labor and capital, the economy is more profitable. Businesses want to employ more labor. They want to employ more capital, up to a maximum. And beyond that maximum, they start to lose profits. So this maximum, you can see that where it maxes out, this maximum is determined by labor share. How much of the total value added national income is paid to labor. That's how this maximum is determined. So I'm going to look at how this maximum is, I'm going to look at this maximum a little closer by using an Excel spreadsheet. Here's a graph of it. So I'm taking that 3-dimensional curve graph you just saw and putting it into 2 dimensions. And once again, we have utilization of capital increasing on the x-axis and the utilization of employment increasing on the y-axis. And if you remember, as the graph went up, it would reach a maximum. That's this orange line. And on the other side of that orange line, the curve would go back down. This would be the maximum profit line on that curve, where the curve comes up, reaches its maximum here, and then starts to go back down in this area. And so I just want to explain the graph here. And then this line here, this blue line, is the effective demand limit, which is another limit based on the dynamics of utilizing employment and capital in response to labor share. And these 2 lines together form the limits of the business cycle based on labor share. So the economy will employ more labor and capital moving in this direction. You can see as the arrow is moving here. It'll reach one of these limits and then starts to reach for that orange line, more profits. And the profits will continue up this way. So that's how this line works. Now these little blue dots you see in here are actually kind of important. That's where these 2 lines cross. Now why is that important? Because it sets up a natural employment. So if you're at a labor share, an effective labor share of 55%, there's a natural unemployment to have it around 96, 97%. That's your so it would be a natural unemployment rate of 3 to 4%. Now, as you raise labor share, I'm raising labor share now, as you raise labor share, that natural unemployment rate rises, or the employment rate decreases. And what that means is that if you're in a situation like in China, where they have low effective labor share that they pay to the workers, they have a high unemployment. They have a high employment rate. And they may think, well, if we pay the workers more, it's going to cost business more, and profitability is going to go down, and that's going to actually increase unemployment. All right? So if you increase labor share, you start paying your workers more, it can go all the way down to a natural unemployment rate of almost 6%. So you've lost, say 2 to 3% employment of your workforce. And so there's an argument against raising labor share in a country like China. However, if they were to keep raising labor share, see how these lines are crossing at the blue dots? The thing is this natural unemployment level stabilizes out at around 95%. So a country like China has an argument not to pay the workers more. It'll cause unemployment. But if they keep raising it, the unemployment will stabilize back out at 95% 95% employment, 5% unemployment. It's tough going back and forth between those two. Now let's go to what the United States is right now. The United States has an effective labor share around 74%. So we've actually moved into this range where the natural rate of unemployment is higher. We used to be, as a country, with an effective labor share of 84%. We used to be into this area where it was stabilized, where the natural unemployment rate was stabilized around 5%. And then through time, we've paid labor less and less and less, and this has actually increased the natural rate of unemployment. Now, there's a lot to be said about this graph, is that the economy tends to gravitate to this crossing point. And beyond this crossing point is you'll have limiting production as you move in this direction up the line. The use of capital is decreasing, so you're holding production steady. The use of labor is increasing, so what you have is more money in the hands of labor. Production is being held steady, but you have increasing GDP from the use of more labor, and that develops inflation. More money in the hands of people chasing relatively fewer goods. So you get inflation beyond this crossing point. So the economy really likes to gravitate to this crossing point here. Now, there would be a lot more to say about this graph, but I'm going to leave the timing right there. All right.